The Nasdaq stock market is currently closed, with Opendoor Technologies, Inc. trading under the ticker OPEN, closing at $7.57 on October 10, 2025, at 4 p.m. GMT-4. Now, the natural expectation for a stock that's been decimated by rising interest rates and a cooling real estate market is to see it simply tread water or drift lower. The prevailing narrative is that Opendoor is a casualty of the Federal Reserve's hawkish stance, a company whose business model simply cannot function when the cost of financing house purchases and carrying inventory is high. But here's the interesting twist that most investors are missing in the noise. Despite these crippling macro headwinds, Opendoor is quietly but aggressively moving to solidify its platform's stickiness and its internal cost efficiencies, a critical shift that suggests the company is preparing not just to survive, but to potentially thrive when the real estate cycle finally turns. And that is a major difference between reality and market expectation. The real story isn't the price drop, it's the operational scaffolding they're building behind the scenes. The general belief orbiting Opendoor is simple. The iBuying model, instant buying, is dead in a high-rate environment. The premise, for those who use services like Robinhood or Fidelity for their online investment, is that Opendoor buys houses, holds them for a short time, performs minor repairs, and resells them for a profit. When mortgage rates shoot up, the buyer pool shrinks and houses sit on the balance sheet longer. That carrying cost, mostly interest paid on debt to finance the homes, eats into the gross profit until it becomes a gross loss, which is exactly what the company experienced through late 2022 and 2023. This is why the stock suffered a minus 7.00% intraday decline on Friday, October 10th. The day's movement, with a high of $8.35 and a low of $7.01 on heavy volume of over 158 million shares, demonstrates extreme volatility, which is characteristic of highly speculative real estate tech plays. The immediate reaction to any weak housing data or a negative analyst note is swift and violent, reinforcing the common perception of vulnerability. The huge spread between the high and low, nearly $1.34, points to a battleground between short sellers and momentum traders who see the 6-month performance, which is up over 669%, as a reason to hold. However, a closer inspection of the trading activity and internal metrics reveals a contrasting reality. The recent trading volume, though high, has seen pockets of institutional accumulation disguised by retail selling and short-term profit-taking. Large institutional players are not buying Opendoor for what it is today, but for the leverage it has to a future drop in interest rates. If you track the major institutional filings, you'll notice that several large asset managers, who are typically value-oriented, not just growth hunters, have been adding small strategic positions. This suggests a calculated bet on the mean reversion of interest rates and Opendoor's newly efficient operational structure. What the market sees as a deeply flawed company struggling with inventory disposition and gross margins, these sophisticated investors see as a highly effective operating model that has been stress-tested by the worst housing market since the financial crisis. The internal operational shift focuses heavily on reducing holding periods and minimizing the price adjustment risk, the difference between the initial offer price and the final sale price. Recent reports indicate they've become extremely disciplined with their purchasing algorithms, prioritizing speed of sale over sheer volume, a direct counter to the growth-at-any-cost mentality that plagued their SPAC-era performance. This subtle shift in strategy, one not often discussed on the major financial news outlets, represents a fundamental change in how the company approaches risk management, and it creates a massive divergence between the low $7.57 stock price and the underlying potential operating efficiency. The dramatic price action is also inextricably linked to the broader macroeconomic pressures impacting all rate-sensitive assets. When the market sees a hawkish turn from the Fed or an unexpected rise in Treasury yields, growth stocks like Opendoor, which rely on low-cost capital, get hit hard, often alongside other speculative tech stocks like Tesla stock or those in the real estate sector. The daily swings in Open are as much about the fear of a prolonged high-rate environment as they are about the company's fundamentals. Retail investors, often trading on platforms like Robinhood app for convenience or using SoFi Invest for their self-investing, are highly sensitive to these movements. This leads to exacerbated volatility, where a minor macro headline can send the stock to its daily low. This speculative sentiment contrasts sharply with the operational reality. Management is streamlining the business, reducing overhead, evidenced by the employee count dropping to around 1470, and focusing on unit economics. While the market focuses on quarterly revenue misses, expected to drop significantly from peak performance, the real insight is in the narrowing of their net loss and the improving home sale contribution margin per unit, suggesting the business can actually approach profitability at a far lower scale than previously assumed, provided those interest rate costs can be managed. To understand the core tension, you have to look at what Opendoor does, which is fundamentally altering the residential real estate transaction process. It offers homeowners a near-instant, non-contingent cash offer on their homes. This is the iBuying model. The company's platform leverages data science and technology to price homes, and its operations handle the necessary repairs and resale. For a seller, it offers convenience, certainty, and speed, a significant premium when compared to the traditional 60-day closing cycle. The business model is a volume game, relying on making a small, predictable margin on thousands of transactions. Past performance was characterized by hypergrowth in a low-rate market, culminating in massive revenue figures, but also enormous losses as the housing market abruptly cooled and the company was left holding inventory purchased at peak prices. The recent history is all about recovering from that inventory mishap and retooling the pricing algorithm to be highly conservative. The current market capitalization sits around $5.57 billion against trailing 12-month revenue of over $5.18 billion. The market is essentially valuing the company at little more than 1x sales, which is cheap for a tech platform, but reflects the market's deep skepticism about the profitability of those sales. This is where the expectation versus reality play becomes most pronounced. The expectation is that their revenues are junk because they are non-profitable. The reality is that they're building a cost-effective infrastructure that, once the macroclimate shifts, could see those revenue figures quickly translate to significant operating cash flow. Another critical factor driving the stock's recent volatility is its high short interest, reported around 150 million shares. This makes it a perpetual target for short squeezes, a phenomenon often observed in stocks heavily traded on accessible platforms like Robinhood. The technical pressure is immense. The stock is prone to sharp, sudden spikes on any positive news, such as the recent, albeit old, talk about integrating crypto payments or favorable regulatory comments about housing supply. These sudden upswings aren't always fundamentally driven. They're often triggered by short sellers scrambling to cover positions. This speculative behavior introduces a layer of risk that a traditional individual brokerage account holder might struggle to manage, requiring a level of monitoring typically reserved for advanced, interactive brokers trading setups. For those utilizing more guided investment help, like Schwab Intelligent Portfolios, the stock would likely be excluded due to its volatility profile. The institutional movements also show a clear divergence. While some are adding, others are stepping back. Analyst sentiment remains highly divided. You see a scattergun of price targets from highly bearish calls around $1 to optimistic targets well above the current price. The average recommendation often sits in the hold category, reflecting this fundamental uncertainty about interest rates. The consensus simply says, we don't know what rate regime we will be in next year, so we can't accurately price this leveraged business. This ambiguity is what creates opportunity for the long-term, high-conviction investor who has done the deep internal analysis. The company's new CEO, Khosrow Nijahian, is aggressively pushing a product-first approach, aiming to make the platform the default destination for all real estate transactions, not just iBuying. This includes mortgage and title services integration, creating a closed ecosystem similar to how Fidelity tries to integrate all aspects of a person's financial life, from simple Fidelity ETFs to complex Fidelity wealth management. This is the key. Moving from a transactional reseller to a full-service platform is a change in the business model that hedges against the cyclical nature of iBuying itself. Looking ahead, the future of Opendoor Technologies, Inc. hinges almost entirely on two things: internal operating efficiency and external interest rates. If the Federal Reserve signals a sustained pause or a shift toward rate cuts, the stock could see a significant rapid re-rating. In a low-rate scenario, Opendoor's newly disciplined algorithm and lower cost structure would allow them to scale up volume safely, turning narrow gross margins into substantial operating profits. This is the reality that the current stock price, tethered by high rates, is not pricing in. On the flip side, the major risk remains a prolonged period of high rates of interest, where their cost of capital remains prohibitive, continually eroding any gain in operational efficiency. Their ability to manage inventory while minimizing exposure to rapidly falling home prices is crucial. They are currently managing this by holding less inventory and focusing on faster turns, a conservative but necessary strategy. The shift to a platform approach, including services beyond the direct purchase of the home, is a defensive move that could provide more consistent fee money when iBuying slows down. It diversifies their income stream, making them less reliant on the speculative success of buying and selling homes. This move echoes the broader trend across financial technology, where platforms like SoFi are building comprehensive ecosystems, offering everything from SoFi stocks and SoFi ETFs to personal money management tools, aiming to capture the customer's entire financial life. Opendoor is attempting a similar coup in the residential real estate realm. The company's next earnings report, expected in early November, will be a critical test. Analysts will scrutinize the home price adjustment